Hi, this is Chris Madarasz, and this is Chapter 3 of the College Accounting 13th edition. And in this chapter, we start to go through the accounting cycle. So, in the first two chapters, you went through the process of analyzing your transactions. So a transaction comes in, and then in this little space between 1 and 2 is the analysis, where you would go through and say which accounts are being affected, are they increasing or decreasing, is this a debit or credit, and then you would use your T accounts for this. As we move through, we're going to be covering these next few steps: the journal entries, the posting, and the trial balance. I'm just going to skip over that stuff because the accounting periods are, the definitions are a little bit important, just understanding what they mean, but I'm not going to spend a lot of time. So a calendar year is a 12-month period covering January 1st to December 31st. So as you're used to a calendar. A fiscal year is a special accounting term where a business can choose when they want to have their year end. So they don't have to choose December 31st. They can choose any 12-month period. They could say, you know what, I want it to end April 30th. So that would be when it would end for them. So it would start May 1st to April 30th. A natural business year is the same idea. It's a 12-month period. However, it's based more around when their busy and slow times are. So a good example is a ski resort would have a busy period and perhaps is busy until the end of April. And then after April, it becomes slower, so they have time to catch up. So they may have a year end that goes April 30th is the year end, and then starting May 1st, it continues on. When you're doing these entries, you're going to be using a general journal. The journal comes from coming from the French word jour, is day. So it's a daily process of going through, and after you analyze the transactions, you journalize them. And by doing this, it's known as the book of original entry. And at the same time, it's the document that all the other documents flow from or flow to. So the transactions come in, they flow to the general journal, and then from the general journal, they flow out to the general ledger accounts. So here's a typical general journal page. And as you can see, it actually has a similar looking T account format. So debits on the left, credits on the right, except we combine the T account into 1 or 2 lines of text here. So the journal will have a page number, will have a date that you record, it'll have a description of the accounts that you're using, and also make sure that you have a description of what the general journal entry is about. We like to do debits first and credits, and after you do a journal entry, leave a space. So on page 131 of the text, there's some different entries here. I'm going to go through these pretty quickly, but hopefully you get an idea of what's going on. So we'll be using this chart of accounts, same numbering conventions that we had before. So assets are the 100s, liabilities are the 200s, equities are the 3s, revenues are the 4s, expenses are the 5s. The cash account, remember, increases debit, decreases credit. All the assets will act the same. So if it's an accounts receivable, increases debit, decreases credit. Expenses, almost always going to be an expense account, but in this lesson, you're going to see one of the exceptions to that. Sorry, almost always going to be a debit to the expense account, and you're going to see an exception. So here it is. First entry says, A. French invested $6,000 in the new placement agency. So which accounts are being affected? Cash and A. French, so the capital account. $6,000, good. What's happening to the cash? It's going up, so it's a debit. So here it is. We record in the journal, put in the date. We say 6,000 debit, 6,000 credit. Notice I don't have anything in this PR column. This PR means posting reference. This only happens after I have moved this number, posted this number to the general ledger account. So up until I do the posting, this number stays blank. And I say it's the initial investment. Next entry, June the 4th, bought equipment for cash. Accounts being affected, cash, and I bought equipment. So my cash is going down, the cash is going to be the credit. That means I need a debit. Debit is equal credits. Equipment's going to be debit for $350. Next entry, earned placement fee commission of $2,100, but payment from Avon Co. will not be received until July. Okay, so I earned it. I earned a placement fee. So if I'm earning something, I guess that's revenue. And I'm not being paid though, but if I was being paid, it'd be cash, but it's not cash. but it's accounts receivable. And Chris said that if it's accounts receivable, it's an asset, and assets are all treated the same. So it's going to be an increase to my asset, so it increases a debit. So accounts receivable is the account because it's receivables, not received. It's receivable, 2,100, and placement fees earned, 2,100 for the credit. Paid my wage expense, $400. Okay, I paid it, so my cash is going down, so that's the credit. And wages expense, that's easy because it says right in the description, wages expense. That's my debit. It's going up, cash is going down. A French paid his home utility bill. Hey, here's a trick. Home utility bill, that's personal. So home utility bill is personal withdrawal. And my cash is going down, so it's $69. Now in this, we exchange checks and cash. It basically means what's happening in the bank account. It's not cash in the pocket necessarily. So we use the word cash, bank interchangeably. So they wrote a check, which has gone through the bank, but we're saying this is all tracked through our cash account. June 12th, placed Jay Diamond on a national TV show, receiving $900 cash. Which accounts? Cash. And I placed Jay. Well, my job is, I guess, placing people. So, and there's this account called placement fees earned, so that must be the credit. Paid cash for supplies. Okay, my cash account's going down. I paid for supplies, and supplies on my chart of accounts is an asset this time. Okay, so I'll have the supplies account asset, and my cash is the credit. Telephone bill received but not paid. So my bill's received. So telephone bill is probably an expense. That's right. It's received, but I haven't paid it. So I haven't paid it, which means it's payable. That'd be accounts payable. And if it was cash, it'd be a credit. So however the cash is affected, it's kind of the same as if another account is affected. So cash is credit. So the accounts payable is also credit. Advertising bill was received but not yet paid. Hey, same idea. I just did this from the telephone. So advertising expense 200, accounts payable, credit. This stuff's easy. Okay. Tricky part. This is where students tend to want to take shortcuts. So the reason I'm making this video is to say, don't do it. Don't take a shortcut. Because if you take a shortcut, you may save a minute today, but later on in the course, because you've gotten used to taking shortcuts, it may cost you hours and time later on. So let's have a look at this ledger account. So as you saw in the first couple lessons, a ledger means a book. In this book is like a card, and all the transactions for a certain account go onto this card. So the ledger has a number of different columns. There's a debit column, a credit column. There's a balance column. This one column that says DR or CR is a spot where you would say what this balance is. If this balance is a debit balance, you put DR. If this balance is a credit balance, you put CR. It doesn't matter if you have a debit here, but the balance is credit, you don't put DR there, you put CR. So hopefully that makes sense. Okay, this slide is a mess, but I will try to show you the process of doing it. So imagine, if you will, that there is no PR here. There are no numbers in the PR. You have your journal entry for the very first entry. Cash, debit 6,000, capital, credit 6,000. Perfect. So I'm going to do the posting process. So what I do is I say $6,000 is going to go to the cash account. I go to the general ledger. I find my cash card, my cash ledger account. I see it's account number 111. Perfect. I record 6,000 into the debit column. Debit, debit. Good. I say where it came from. It came from general journal page 1. Happened on June the 1st. Okay. And where is it going to? Well, it's going to account 111. So then I go back and say account 111. So this is the important process I was saying. Don't cheat on this. Don't go through and do all of this posting first and then go through and say, well, they're all from general journal page 1. So I'll just say GJ1, 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 and go down. You'll see what I mean as you start to get into it. And you'll just copy all those, and then you come back to your journal page and then put all the account numbers. That's a common shortcut. More often than not, it's the same people that take that shortcut that contact me around chapter 5 saying, I'm out of balance, I can't find it, and I've spent 4 hours and I hate bookkeeping. So the process is this. I'll do it again. Take the $6,000, you put it into the ledger under the debit, $6,000. I say where it came from. Now you can put the date in, that part doesn't matter. The most important part is this: 6,000 goes into the ledger. Where did it come from? It came from GJ1. Then you go back, figure out the balance, back to the journal, say where did it go to? 111. Then you do the next line. Next line, it's a credit. It's going to the capital account. I go to the capital account, say it's a credit in the capital account. Where did it come from? GJ1. I can put the date, I can do the balance. Important part is I come back and I say, where did it go to? Then I write 311. I write the account number to where it went to. Now, the reason you want to do this is because interruptions happen. It's never an ideal situation where you're sitting down and you can work through this. I shouldn't say never, but let's say that you have kids or a dog or cat or family or a job or a telephone or a computer. All of these things can cause interruptions. So as you're working through this process and as you're doing the posting, if you follow this step, it's easy to see if you've finished a transaction or if you still have something to do. So for example, I have 6,000. I go and I record it into the cash as the debit. I say it came from GJ1, and then, oh, my phone rings. So off I go. I answer the phone. I come back. I say, okay, what happened? I don't see a posting reference here. There was no posting reference. So I go and say, oh, maybe I didn't do this. I go to 6,000 and say, oh, it is there. And I said it came from GJ1. I just didn't say it was posted. So then I can say, there, I posted it to 111. If I don't have anything in there ever until the very end, and I try to take the shortcut, and I go through this process and I'm distracted, I actually have no idea if I finished that posting or not. Because I would say, oh, I guess I'm on this next number, and off I go. Okay, so it's really, really important, and please trust the process because this will help. It'll seem really tedious, and quite honestly, this bookkeeping step, this manual bookkeeping, is very tedious. The computer systems that we have that you're going to be using later on in the program, they really, really speed this stuff up. All this stuff happens in the background. And even as you get into some other chapters in the second part of the bookkeeping course, where they have special journals, a lot of this stuff will tend to take care of itself. But for right now, just while you're understanding how everything works, it'll help you when you have to analyze books later on. It'll help in your learning process, okay? So here it is. Here's the ledger account, all of these transactions. Just notice here that I don't repeat June, June, June over and over. I just say it once at the beginning of the month. I could say if I wanted to, the date up here, I could say it's 2018, and then if we did cross years, I could add a line that says 2019 and start again. Notice here that even though this is a credit, the balance is still debit, so I have debits in that column. So next step, after you do these transactions, so there's 3, 6, 9 transactions, you would post all these 9 transactions from page 131, problem 3-3B, and off they would go. There would be ledger accounts. Then what I would do is I'd go to the ledger accounts. I would look to see what is my ending balance on the ledger. And then I can prepare a trial balance. So with the trial balance on the left-hand side, I would say here are all the different accounts that I have. Then I would look at those ledgers and I look at the ending balance or the balance at whatever day I'm doing the trial balance. And I would say, here are the numbers that I have for every general ledger account. I would put those numbers in, the debits and the credits. I would add them up. And this is where I find out that either I made a mistake and I'm not in balance, or please, everything's balanced and it's perfect and off I can go. There's a little section in here about making corrections, and it's kind of funny. As bookkeepers and accountants, we don't like to see erasing marks on stuff because we never know exactly what was there before. Why was it erased? Was it something important? Was it something that was changed? Just need a little sip there. So what happens is that we like to draw lines through stuff. So if there's an error and we discover an error in the books, we don't erase stuff because auditors don't like that. We draw a line through it and then we put the corrected amount above. And then we even initial it too. If we do find an error, we have to make sure that the books reflect that error. So there's what's called a correcting or adjusting entry that has to be done. So in this example, the telephone bill that was received and journalized on May the 23rd, so we had a telephone bill, something happened and for some reason it was posted to the advertising expense. Don't know why, it just happened there. We have to take it out of advertising expense. So what I do is I say, okay, here's my journal. I have to take it and increase my telephone expense by 180, and I have to take it out of the advertising expense. So I have to credit that by 180. Then ignore those numbers. They shouldn't be there because I would have to post it. So then I would go to my general ledger and say, there's my debit to my general ledger. I would say, where did it come from? I would write in GJ1, sorry, GJ3, because that's the page. And then I would say, where did it go to? I went to account 313. Next, that's not there. 180 credit, I had to go to my advertising expense account. There's my, oh, sorry. Advertising expense, I was looking at the wrong number. Let's take this back. Okay. I need to debit my telephone expense, account number 513. So I don't know the account number. It's not here. I haven't posted it. Go to account 513. I say debit. Where did it come from? GJ3. I can figure all this other stuff out at the balance. I go back to my journal to see what do I need to do next. I say, oh, I just finished that one. It went to account 513. Next entry, that 512 is not there yet. I go to the advertising expense general ledger. I say I need to do a credit to there. Where did it come from? GJ3. In this case, I say this is a correcting entry because expenses almost always never have credits in them other than adjustments. So here's the exception. So there's an adjustment. I say this is a correcting entry. Where did it come from? Came from general journal page 3. Where is it going to? It went to account 512, and then I would move on to the next entry. Okay, hopefully that makes sense. So those are the steps in the accounting cycle that you're doing. Pretty soon they just become automatic, but I know there are some quiz questions and things like that that talk about the steps. So a transaction occurs, you analyze the transaction, record the transactions in the journal. Okay, so you have to analyze it. After you record the transaction in the journal, you post the information from the journal to the ledger. Now a question often comes up, how often do we post? Well, if you're doing this stuff and you're working on a daily basis, I would say that, you know, if you're doing general journal entries, you would post them daily. Later on in the course, when you start doing some special journals, they actually only get posted at the end of the month because you total up stuff. But for now, I would say as you do every entry, I'll leave it up to you. There's no right answer, but if it was a work environment, I would say it's probably best to post it daily. After you post the information, you prepare the trial balance, make sure everything balances. So that's all there is for chapter 3. This is when you're getting into the nitty-gritty. You're moving from the T accounts and getting into the journal pages. And this is the beginning. So hopefully things are calming down a little bit. It's not seeming so overwhelming. It's the practice that makes this stuff really stick into your head. I remember when I was in school and I took an accounting course, it was all foreign. I didn't even have a bank account. I didn't have a checking account. I had no idea what this stuff was. And my instructor asked me he had a question saying, talking about capitalization of capital assets and how that works. And I stuck my hand up and I said, and I'm a kid among 30-year-olds. And I just said, what's capitalization? To me, capitalization was just capital letters. And I remember he looked at me and said, what, are you stupid? And I thought, oh, this is going to be a long year. Now, for the first time in my life, I actually got a C+ in a course, and I was a little bit devastated. That wasn't the worst I ever did. I did worse in finance. I got a D in finance, so I had to take that one a couple times. But I chalked it up to my youth because it's funny. In finance, I had the D and ended up being asked to teach it at a college level when I was in my 40s. And anyways, so anything's possible. This stuff feels hard at first, but trust me on this. In a few weeks, it'll just be second nature. Your biggest gripes are going to be that it's not perfect. So, hey, last tip, don't aim for perfection. And the reason I'm saying that, it's a great lofty goal. So many people get so frustrated because they want to be perfect and they spend so much time trying to get the perfect mark. And this textbook is designed to make you make errors. So I'll just say that right now and I'll say it again. This textbook is designed to make you make errors because I believe the philosophy they have is that people learn more from their mistakes than from just doing everything right all the time. So as you go through certain chapters, there may be some ambiguities that come up. There may be something where you get an answer incorrect and you lose 2 marks out of 100 or something like that. I don't want you to freak out and say, this is not in the textbook. You're right, it's not in the textbook. You still have an A plus. It's a way that they say, you got it incorrect. Therefore, you'll probably never get an incorrect again because you'll say, oh, why did I get this wrong? And you'll learn it that way. So keep that in mind, and I'll see you in the next chapter.